What's going on, guys? Welcome back to my channel. This is Blood Phantom 81. The lighting in this room is obviously very bad, but that's okay. In this video, we're going to be talking about SPHD. SPHD forgives all, and so we're going to be talking about how I'm getting a 10%, over a 10% yield on cost on SPHD. Now, the purpose of this video is not to promote SPHD in any way. It comes with its own set of risks. I even talked about how you shouldn't make it a core holding. I still agree with that. And there's probably better ETFs out there, right, in terms of total return. Not probably, there's definitely better ETFs out there in terms of total return. This is just an example of getting creative when it comes to dividend paying stocks and how to boost return. A lot of you probably already know what I'm about to talk about, but in this video, we're going to dissect it a little bit more. So, yeah, SPHD, as we talked about, it is not that favorable in the current market environment where value still has a long way to go if it ever wants to catch up to growth. Right, there's a huge discrepancy. And yeah, as a result, SPHD is getting hit hard and it's not moving that much. But is there a way to make money while you wait, right? Is there a way to make money off of stocks not moving that much? And so my SPHD position is around 14,000, let's say $200. So it's a pretty decent chunk of change, right? It's not like you don't just find this off the street, unless we're talking about the streets of yeah, I don't even know where I'm going with this. Anyway, so yeah, so $14,200. Average cost at around 33.25. I definitely bought the dip and I've been continuing to buy the dip. Whenever basically my average cost is down, I end up buying a little bit. And I ended up buying some, I think well, why don't we just go ahead and check actually when I bought some so I don't make this up. All right, so I started to really pick up my purchases starting on April 6th, it looks like. So in fact, I always had maybe 100 shares and that's why I have a $17 dividend. But yeah, ever since then, I spent $2,700 on 90 shares here on April 6th, and then another 800 on April 8th, another 800 on April 13th. So basically buying it every week or so. And then another, let's say 1600 on April 27th, and then the dividend started to roll in. And then I started to do basically this covered call strategy, which is why you see all these options, right? Call, sell. Aren't calls risky? You might be wondering. And so they're not actually risky when you sell them. And so we'll go ahead and talk about that later in this video. But just to sort of recap, I even started buying back in July, July 8th, another $800 worth, another $800 worth on July 9th, and then another $1,600 worth on July 9th. And I haven't bought any since, right? And so SPHD, since it is showing something of a discount, especially when my average cost goes negative, I actually end up scooping up more shares. And so let's go ahead and actually take a look at my most recent transactions. So take a look at this. This is everything between August 1st, right? And let's say mid-July. $60 plus $35 plus $20, right? I believe that is $115 if I did my math correct. Wait a second, 55. Yes, that is $115. And so that is just from SPHD alone. Now, what are these? What these are options premium contracts that I am selling. I'm selling these to people that are buying options contracts. And as a result, I keep the premium. The way I deal with SPHD is I actually end up buying one that's a little bit closer to the money and two that are not as close to the money. So they end up being not that much different in terms of total value. Just to sort of summarize that, SPHD has made me $115. Let's go ahead and take a look at how much that is annualized in terms of total return and yield on cost. Okay, so we're back here at my average cost. So you might be thinking, okay, you're getting $115. Let's go ahead and take $115 and we're going to go ahead and multiply that by 12. And so we get this, right? So you're probably thinking, why don't we take this and then divide by what it's worth right now, 14,199, and say, okay, you're getting a 9.7% yield, which may be technically in some way that is true, but what I really care about is yield on cost, okay? So here's what I'm going to do. So this is what it's worth now. But this is not yield on cost because my total return is plus $700. And considering that, I've reinvested some dividends. So the dividends that I reinvested are about 5 shares, and 5 shares worth of SPHD is around $150. And so what we're going to do is take this amount, we're going to put it in parentheses, and we're going to subtract this by 150 by what I'm currently up on this, which is 705, and boom, now that's a more accurate representation of what my actual yield on cost is, which is a 10.3% yield on cost. So to summarize that, based on the money that I put into SPHD, that money is working for me at a 10.3% pace. Now, one could argue that selling covered calls is not passive income. I guess, yeah, kind of, right? I mean, you do have to swipe up on your phone. But that's the thing. That's all it is. Is just a few extra swipes a month, really. Maybe like 2 or 3 swipes a month. If you want to do it, you don't always have to do it. And that's where the income comes in. And so a 10.3% return on money is basically sort of the mid to upper end of what you can expect the market to return on most years, right? In terms of just historical average. And I'm doing this through an ETF without really taking on that much risk, I would say. I mean, of course, there is the risk that the ETF, goes down in value a whole bunch. So maybe you want to pick another ETF that you like more. I have my reasons for why I like SPHD myself. So now I'm going to explain a little bit more about what covered calls are and how to do them basically. So when you have 100 shares of a company or an ETF, you are now eligible to sell covered calls against that stock or ETF, right? That's the amount that you're putting up in terms of risk. However, when I say risk, there's actually not that much risk. And I'm not like making this up, right? I'm not like a used car salesman right now. You can actually do more research on this if you want later. But the idea is all the risk lands on the person who's buying the option from you. Now you might be thinking, why would that other person be taking so much risk when I'm not taking any risk at all? And the reason is because if the other person is right, basically the person who's buying the option contract, then they make a lot of money, right? They make some payout because generally buying options gives you more leverage than just buying the stock outright. And the other thing on risk is, yes, you may be taking another sort of slight risk in that there's something called opportunity cost. So in this particular case, right, I'm selling covered calls at $35 and $36 a share, respectively. And so if SPHD ends up going above that, and actually we're super, super close, if SPHD ends up going above those prices, then my shares would get called away at these levels. Meaning, if SPHD would reach $38, $39, right, which, I mean, good luck seeing that happening. But if that were to happen, I would only get paid up to this particular amount. And so I'd be missing out on that little bit of profit. And so there is sort of like a strategic element with selling covered calls that I don't think I'm going to get into this video. I just wanted to make a quick one. But yeah, that's the idea, is that when you're a shareholder of a company, you can actually make an additional stream of income using covered calls. It is not something that I've been doing for a super long time, right? So I'm still finding out my strategy. I think I've already found like something I like and something I'm comfortable with, but that's just like another instance of making the most of what you have in front of you. So with that out of the way, hope you guys enjoyed the video, and I will see you guys in the next video.